Craig Bolanos. Craig's with VestGen Wealth Partners. And okay, Craig, as we jump in here, there are times I feel kind of like Goldilocks here.
You know what? I don't yet have grandkids, but if I did, I would be reading them that fairy tale right now. I mean, after all, we got cooler inflation. We don't have a meaningful deterioration in the labor market. Last time I checked, that equals Goldilocks for everybody. You know, you got inflation moving in the right direction. It might not feel like it for real life, but the reality is Wall Street cares about data, and the data-driven analysis is we've had month over month and year over year decreases in core inflation. You take that with a market at all-time highs, feels like a fairy tale. Goldilocks, pinch me. Is it real?
Well, let's talk about inflation as well. I mean, we've had now CPI, we've had PPI numbers basically falling in line here with most analysts. Where are we as far as inflation? Your thought?
Well, yeah, I mean, I think we're in this spot here where, you know, you strip out what I call the volatile part, you know, the food and the energy, which is what most of us care about the most because it's the high frequency data. But when we look at wage pressure, when we look at shelter, we're making definitive, meaningful progress, Tony, and we have to think about what ultimately is deflationary. Everything artificial intelligence, intermediate to long term, is in fact going to be deflationary. It's about increasing productivity per unit of labor hour of work. That's a fancier way of saying people can do more output because of the tools that we have. So I think the war on inflation hasn't been won, but I definitively think great progress has been made.
All right. You've mentioned at least one, if not both of the things the Federal Reserve has on their radar. What's happening with by the way, this is, I think, a new Federal Reserve, a new era in the Federal Reserve. Your thoughts?
Well, yes, it's absolutely a new era. You know, when we talked to all of our clients at VestGen Wealth Partners, you know, we said we have nothing bad to say about the new Fed chair Warsh, but we do view it as a risk. A new Fed chair is always a risk because the Fed chair is currently untested. But why would you say that it's a risk? Why would you say it's a new Fed? He's viewing everything with a new lens. Warsh has ushered in a Fed that reminds me not of Janet Yellen, not of Ben Bernanke, a Fed, certainly not of Jerome Powell, but maybe the early days of Greenspan. That's a Fed that's more humble, a Fed that's going to be more quiet, a Fed that is resolute to combat inflation while also maximizing employment, the dual mandate. And the Fed is going to be in a position as they're not as forthright. They're not going to be saving the stock market. They're not here to save the wealth effect. They're here to do their job. Investors aren't going to like that because it's going to create more volatility. But remember, volatility is opportunistic because volatility is different than risk.
Mentioned employment. We got jobs numbers. What was it yesterday? Initial, continuing. I had us at 209 on the initial and 1.777 on the continuing. Where are we?
Yeah, that's right. I mean, with continuing claims at 1.7 million and initial jobless claims at 209,000, I think what it means to everybody is we remain in what I call this low fire, low hire, this slower market. That is nothing that is recessionary at all when you look at the headline data. I mean, you would know if the jobs numbers were recessionary because you'd see the repo guy taking your neighbor's boat and RV in the middle of the night. You'd see a short sale or a foreclosure on property, and you just don't see those widespread throughout America.
You mentioned repo and recession and all of these things that we talk about, inflation, and it takes me back to the 80s. And really, I've been kind of focused here on some of the things that set us up in the 80s for disaster in ag and rural America. And the bond market actually took over running this country for a while. What's happening right now?
Well, you're right. One of the things is, while I'm positive, clearly I'm positive with all these economic signals, the bond market is a little bit of a mixed bag. You know, short-term yields have come down recently, but the intermediate to long side of the curve is stubbornly high. And I think what that tells you is that the bond market, is it the smart money? They're worried about fiscal discipline. They're worried about fiscal deal discipline. They're worried about the deficit. They're worried about the long-term structural function of the United States and our ability to meet our obligations. So that should have everybody that we employ in Congress, because again, Congress works for us, both on a federal and a local level, to start being better stewards of our money, because you're right, we don't want the bond vigilantes coming out and controlling the market by holding us hostage with higher interest rates and causing us to have painful choices.
Arizona Representative David Schweikert is the chairman of the Joint, and I forgot what it is, Joint Economic Committee. So that's between the Senate and the House, and they're focused on trying to solve this issue. He has said that he's got the agreement now from the Speaker to bring this up after the August recess. So we're talking about the bond market here, but what about the stock market? Does it factor into this at all?
Well, I think it does, only in the sense that the biggest risk for everybody watching us right now, Tony, is going to be complacency. Complacency. Thinking we have more time to start seeking positive cure to the ailments that are causing bond yields to be higher. Complacency with stock markets at all-time high, that the stock market is telling us everything is fine. I think there's no room for complacency when it comes to finance. There's no room for complacency when it comes to business. There is no room to complacency when it comes to legislative progress. The goal of America is to adapt, improvise, overcome, and that's exactly what we need to be doing here, both as leaders, thinkers, business owners, and people of faith.
I've been thinking about this a lot lately. I think our federal debt at this point is the biggest issue that we face possibly in our lifetime right now. We're on the brink. I don't know if you agree with me on that, Craig, but if we don't solve this, and I say we, it's going to be painful for anybody. I mean, whether we're talking Social Security, Medicare, Medicaid, Farm Bill, whatever. This is going to be painful, but if we don't solve it, is the other side of this even worse?
Well, the other side of a cliff is always worse, because once you start falling, you can't arrest the fall. So the good news is this. I don't think we're on the brink. The problem is complacency. I worry people don't end up making positive, constructive change up until they're literally facing the ledge of the cliff. And that's going to be 2032 as an example for at least one of those entitlement programs that you just mentioned. Gee, that's what, 5.5 years away? That's not much. But I see some positive direction coming. Believe it or not, I would argue that Trump accounts for kids, Trump IRAs that start in 2027, the privatization, the implementation of free markets and investing in great companies of America are an acknowledgement that some legislators, including bipartisan legislators, despite the name of those programs, recognize the issues that are here. You just gave me a little bit of enthusiasm that you mentioned that the go-between relative to the finances is something that's going to be talked about in the month of August, or at least once we get through that recess. So, Tony, let's have some hope. We're not yet on the brink, but we use this television program to create awareness, because I know our viewers, the listeners of this show, are information junkies and they want to hear the truth. And it's good that we speak to exactly such.
Craig, great to visit with you. Let's get the website address. This one's easy to remember.
That's getretiredstayretired.com. Getretiredstayretired.com.